Welcome to this special Optivest deep dive. Today we are digging into the financial anatomy of AgStar PLC, or AGST. And, there's this deeply ingrained psychological quirk in how we look at financial markets.
Oh, absolutely. The rubber band effect.
Right, exactly. You see a stock chart where the price gets pulled way down from an all-time high, and your brain just automatically assumes that eventually it has to snap back. And right now, the retail investor community is completely paralyzed by this exact quirk with AgStar.
Yeah, they're looking at a stock that collapsed from a peak of 21 rupees down to a current trading range of around 7 rupees.
And a lot of you listening are probably looking at that 7 rupee price tag and thinking, wow, this is a massive temporary discount.
Right. It's the gambler's belief in the inevitable bounce.
Yeah.
I mean, it is comforting to think that what goes down must simply come back up.
But our thesis for this forensic analysis is a bit of a harsh reality check, isn't it?
It is. The Optivest thesis here is that the mean for AgStar has structurally shifted. The rubber band hasn't just stretched, it has completely snapped.
Wow, so this 7 rupee price isn't just a temporary discount.
No, it is a permanent new reality. So today, we're going to benchmark them against their peers, debunk the academic fallacy that's keeping retail investors hooked, and pull back the curtain on the balance sheet illusions, masking some severe operational decay.
And we'll also reveal why the smart money has already quietly headed for the exits. But before we even touch AgStar's current balance sheet, we really have to dismantle this psychological trap.
Yeah, we need to look at the death of mean reversion. I mean, if you are basing your investment strategy on the assumption that a stock will always return to its historical average, you're ignoring decades of modern financial research.
Right, like that landmark study in our sources by Kim, Nelson, and Starts on empirical evidence in stock prices.
Exactly. They analyzed massive sweeps of market history, and they found that, sure, if you were investing between 1926 and 1946, mean reversion was a very real phenomenon.
Stocks did tend to snap back to their historical averages back then.
They did. But their research points out a massive pivot in the post-1946 era. The phenomenon effectively vanishes.
Right. Modern stock returns don't reliably revert. They exhibit what the researchers call persistence, meaning when a stock finds a new trajectory based on a structural shift in the business, it just stays there.
Yeah, the market has just become a lot more efficient at pricing in those structural changes. And AgStar is a textbook case of price persistence.
It found a new lower orbit of 7 rupees, and it's persistently staying there because the underlying business itself is fundamentally different now.
And yet, retail investors are still anchoring their expectations to that 21 rupee peak from the 2022 to 2023 financial year.
To understand why that's a trap, we have to look at the mechanics of how they got to that peak in the first place, right? Because that was not a normal business cycle peak.
Not at all. We have to set the stage for you, the listener, to understand the macro environment of that specific year.
Yeah, Sri Lanka experienced a severe foreign exchange shortage, which triggered a sudden overnight policy decision by the government to completely ban the importation of chemical fertilizers and agrochemicals.
And just to be completely clear here, we are entirely neutral on the politics of that policy.
Well, 100%. We are only analyzing the financial fallout detailed in our sources.
Exactly. The reality on the ground was an immediate, catastrophic shock to the agricultural supply chain. Farmers were desperate because traditional chemical inputs simply disappeared from the market.
But AgStar had a unique pre-existing advantage. They already had an active organic fertilizer portfolio and domestic production facilities.
Right, while their competitors, who relied almost entirely on importing chemical fertilizers, were frozen. They couldn't get letters of credit or clear goods at the port.
But AgStar was already churning out organic compost domestically.
So the mechanics here are crucial. It wasn't that AgStar suddenly became an exponentially better company. It was that the government inadvertently handed them a temporary monopoly.
They were the only ones who could fulfill the massive organic fertilizer tenders. Their organic volumes shot up by an astonishing 302%, basically because they were the only game in town.
It was a classic fake peak. A black swan event temporarily handed them a massive margin advantage in a captive market.
So expecting a stock to revert back to a crisis-driven spike is a fundamental logical fallacy.
Exactly.
Wait, let me play devil's advocate here for a second, though. I am looking at another academic source in our stack, a recent comparative analysis on modeling market expectations of profitability.
Okay, go ahead.
Their research on partial adjustment versus mean reversion models shows that profitability does mechanically revert toward the industry mean by about 20 to 30% annually.
Right, stochastic mean reversion.
Yeah, for the listener who isn't a quant, this concept basically suggests that natural market forces like competition and capital flowing will naturally pull a struggling company back to the industry average over time.
That is what the theory says, yes.
So if AgStar is underperforming right now, shouldn't those standard market forces pull their profitability back up?
Well, that study is widely cited, but investors often misinterpret the application. The researchers note that stochastic mean reversion is mechanical only when deviations are cyclical or random within a fundamentally sound business.
Oh, I see.
Profitability reverts if the underlying engine of the company is intact. But reverting to a black swan monopoly spike, that defies the laws of market physics.
Because past profitability for AgStar is just a historical artifact of that specific supply chain crisis.
Precisely. The central tendency of the company itself has moved permanently downward.
But wait, if the whole country went through an economic crisis, couldn't AgStar just argue they are victims of a tough macroeconomic environment?
To buy that excuse, we have to look at the boat sailing right next to them in the exact same waters. We really need to isolate AgStar from its peers.
Okay, let's do the sector benchmarking then.
If the entire agri-input sector is bleeding, you might argue it's a systemic market issue. But when we look at industry heavyweights like CIC Holdings and Hayleys Agriculture, the data tells a radically different story.
Let's look at the 2024 to 2025 financial year. The macro crisis from 22-23 hit everyone in the sector, obviously.
Right, but look at how the peers adapted mechanically. CIC Holdings diversified their portfolio, stabilized their supply chains the moment the chemical ban was lifted, and just reported a massive 6.63 billion rupee profit after tax.
Billion, with a B.
Yes, with a B. And Hayleys Agriculture maintained incredible resilience too, posting a 1.55 billion rupee profit after tax.
So they absorbed the macro shock, recalibrated their core chemical and seed businesses, and just moved forward.
And then we look at AgStar for the exact same 2024 to 25 period. They reported an operational loss of 208 million rupees and a net loss of 366.6 million rupees.
Wow. That divergence is the smoking gun, isn't it?
It really is. While CIC and Hayleys are generating billions in profit in the exact same economic climate, AgStar is hemorrhaging hundreds of millions.
It proves that AgStar's continued stagnation is a result of internal structural decay. It is not a systemic market problem.
No, it's not.
It is like sitting in a sinking rowboat, bailing water and blaming the rough waves, while CIC and Hayleys are cruising past you in the exact same ocean.
I love that analogy. The water isn't the problem. You just have a massive leak in your hull.
So if we put on our Optivest forensic analyst hats, we need to locate that leak.
We do. We have to look at exactly what broke inside AgStar's operational engine. The environment they operate in became structurally tougher, and they lost their unique advantage.
Because when the chemical fertilizer ban was reversed, imports flooded back in.
Exactly. Their organic monopolies evaporated overnight.
Suddenly, they went from selling high-margin organic products in a captive market with desperate buyers to fighting a brutal price war in the traditional chemical space.
And they are fighting against massive established competitors. Plus, they are now dealing with structurally higher raw material costs on a global level, combined with higher local finance costs.
So their margins didn't just shrink, they permanently compressed.
Yes, but if you read their recent reports, management is definitely trying to fix the leak. They are pivoting.
Right, they're rebranding their core product to Brown's fertilizer.
And they are rolling out a whole new ERP or enterprise resource planning system to integrate their digital data.
They're also heavily investing in drone-based smart farming technologies and building brand new quality assurance laboratories.
Which mechanically, deploying drones for precision agriculture and upgrading software sounds exactly like what a modernizing company should be doing to survive.
Right, so shouldn't we give management credit for adapting? That sounds like a solid plan.
Well, it reads beautifully in a glossy annual report, and we do acknowledge the effort, but let's apply the forensic lens here.
Okay.
The stock market does not pay for effort. It only pays for results. Implementing an ERP system isn't just installing software. It cost millions in licensing, IT consulting, and operational downtime.
And drones require capital expenditure, trained pilots, constant maintenance.
Exactly. So until those drones and new software systems actually stop the cash burn and expand the gross margin, they're just expensive cost centers.
I see. They are expenses dragging down the bottom line, not actual value drivers yet.
Management is making a highly speculative bet on the future, but
Yeah.
right now that bet is being funded by severe operational losses.
Wait, I'm looking at the balance sheet data from our sources right here, and this is where the math stops making sense to a casual observer.
Oh, this is the best part.
If their core operations are bleeding to the tune of a 208 million rupee operational loss, how is AgStar still projecting this facade of financial health on paper?
It is quite a trick.
I mean, I am looking at their total asset base for the 24-25 period, and their total assets grew by a staggering 56%, reaching 14.29 billion rupees.
Yep.
They lost 366 million on the bottom line, but assets went up 56%. The only legal way that happens without a massive cash injection from selling more shares is if they are playing games with asset valuation. Is that what I'm seeing?
That is the exact mechanism. This is what we call the balance sheet illusion. In the regional financial space, we playfully call this the LOLC maneuver.
Right. And for context to the listener, LOLC is a massive corporate conglomerate known for aggressively revaluing their physical assets to boost the appearance of their balance sheet. No pun intended with the maneuver name.
None at all. And AgStar is employing that exact same tactic. You have to look past the net income and look at the total comprehensive income line.
Okay, mechanically, how does total comprehensive income work for the listener who isn't an accountant?
Sure. The standard income statement shows your revenue minus your expenses, which gives you your net profit or loss.
Simple enough.
But accounting standards allow companies to add another section at the very bottom called Other Comprehensive Income. This is where you put paper gains that haven't actually been realized in cash.
And for 24-25, AgStar reported a positive total comprehensive income of 810 million rupees.
Right, and that massive positive number completely swallowed their 366 million rupee actual net loss.
So where did that 810 million come from if they didn't make it from selling fertilizer?
Asset revaluation. They hired independent professional valuers to look at their physical property, plant, and equipment, specifically their lands, their buildings, and their motor vehicles.
Oh, I get it. The valuers concluded that local property values had gone up, so AgStar literally just wrote a larger number on the balance sheet.
Exactly. They didn't sell any extra product. They didn't invent a better fertilizer. They just said, hey, the land our factory sits on is worth a lot more this year.
And to be crystal clear, this is a perfectly legal, standard accounting practice, right?
Oh, it is entirely legal, but forensically. It is a brilliant way to mask the severity of operational failure.
Because you have a negative bottom line from your actual day-to-day business,
Well,
but you magically generate a positive comprehensive income on paper.
it makes the company look robust to an untrained investor quickly scanning the top-level numbers.
That is wild. It's like taking out a high-interest payday loan just to pay the electric bill for a factory that isn't producing anything, but then getting the factory building reappraised for double its value.
That's exactly what it is.
On paper, your net worth went up, so you look rich. But in reality, you still don't have the cash to pay your workers. You cannot pay off debt or issue dividends to your shareholders with the revaluation reserve. You just can't spend paper.
That is the perfect analogy. You are asset-rich on paper, but cash poor in reality. Which brings us to the ultimate forensic tool, the pulse test.
Because in forensic accounting, we have a saying, right? Profit is an opinion, but cash is a fact.
Exactly. Profit can be manipulated by accruals, which is just recording revenue before the cash actually hits the bank account, and by these massive asset revaluations.
But the operating cash flow statement doesn't lie.
No, it doesn't. And if we look at the pulse, the cash flow, the patient is in severe distress. Look at the mechanics of their finance costs.
Right. In the previous year, 23-24, they actually had a net finance income of 82 million rupees.
But in 24-25, that swung violently to a net finance cost of 160 million rupees.
So they went from making money on interest to paying massive amounts of interest to the banks. Why the sudden swing?
Because when you are running a 208 million rupee operational loss, and your collections from the dealers who buy your fertilizer are delayed, which management explicitly noted in their reports, how do you keep the lights on?
You borrow.
You borrow. They're relying heavily on short-term credit facilities just to maintain inventory levels and keep the business moving.
So they are borrowing real cash at high interest rates to maintain the appearance of a strong fortress while the core business burns that cash.
And the asset revaluation just makes the fortress look bigger from the outside while the fire is raging inside the walls.
Wow. So let's tie this all back to you, the listener. We started this deep dive talking about the retail investor community staring at that 7 rupee stock price, paralyzed by the mean reversion myth, waiting for the rubber band to snap back to 21.
Right.
What is the actual danger of sitting in this stock right now?
The danger is falling into the gambler's trap. Retail investors often look at a stock merely as a digital number on a screen that has to fill a gap on a historical chart.
But a stock is a fractional claim on a living, breathing business.
Exactly. If the fundamental economics of that business change permanently, like if the chemical ban is lifted, if the margins compress, if the competitive advantage disappears, the number on the screen should not return to its past high.
And here's the truly sobering part. While retail investors were busy buying the dip at 15 rupees and then buying again at 10 rupees, thinking they were getting a rare bargain, what was the smart money doing?
If you look closely at the shareholder migration patterns over the last 2 years, in the sources, the institutional investors, the major banks, and the large funds, they understand the mechanics we just discussed.
They saw the margin compression.
They saw the balance sheet illusions. And they quietly used the liquidity provided by the retail investors who were buying the dip to exit through the back door. Yeah. The retail community essentially provided the exit liquidity for the smart money to leave the building.
That is a tough pill to swallow. But let's play devil's advocate one last time. Let's say a miracle happens. The rebranding to Brown's Fertilizer works flawlessly, the drone tech revolutionizes their cost efficiency, and AgStar actually does touch 21 rupees again, say 5 years from now.
Okay.
Isn't the retail investor who held on vindicated?
Even in that absolute best-case miracle scenario, the retail investor still suffers a massive loss. The reason is opportunity cost.
Walk us through the mechanics of that.
If you tie up your capital for half a decade in a stagnant stock just waiting to break even, that is a catastrophic financial decision.
Yeah.
You have to compare that frozen capital to the risk-free rate.
Right, like if you simply place that capital in a standard government bond yielding, say, 10% annually, that money compounds year after year with virtually zero risk.
Exactly. While you wait 5 years for AgStar just to crawl back to your purchase price, your money is losing purchasing power to inflation, and you are missing out on actual high-growth sectors that are generating real cash today.
Breaking even after 5 years isn't a victory, it's a massive hidden loss. And as always, we need to be very clear here, this deep dive is strictly for educational purposes.
Absolutely. Our forensic analysis is based purely on publicly available data, audited annual reports, and academic research provided in the sources. We are not providing investment advice, and you should always do your own due diligence.
Right. The overarching lesson in forensic analysis here is about looking under the hood. You have to look past the top-line revenue, look past the legally revalued assets inflating the balance sheet, and find the actual cash flow.
Because the numbers tell a very specific story about price persistence. Stocks don't return to their past, they follow their future. And for AgStar, the mean has permanently moved.
So we leave you with this final provocative thought to mull over. The next time you open your portfolio app and you see a stock trading at a massive 60% discount from its all-time high, ask yourself, are you looking at a rare, misunderstood bargain? Or are you just staring at the ghost of a business model that no longer exists?